Now we pivot to Asia, where there's nothing but fun headlines and views on what is going to happen with Chinese zero COVID policy. And we're going to get to that in a minute, but we want to look at what are some of the things that are happening on the Chinese economic front, because that's why it's so important about what is going to happen on the zero COVID policy. So here you can see that the trade balance was abysmal. Exports got absolutely trounced. It was expected to be up 4.5%, came in at a negative 0.3. Imports were expected to be flat, came in at negative 0.7. But I like to keep things consistent using the renminbi. And here you can see that exports were expected to be up 12.7, came in up 7. Imports were expected to be up 10, came up 6.8. Now, the reason why that's important is because imports were down more than exports. And imports are a leading indicator for two things: where are exports going to be and what is domestic demand? And on every metric, it missed in a big way, which is, again, a growing problem, but not surprising based on what we talked about in segment one. Declining new orders, declining TEUs. So again, you're seeing that bleed down, which is resulting in a collapse in the trade balance. Now, foreign reserves slightly better, was expected to be at $3.039 trillion, came in at $3.05 trillion. $3 trillion is a magic number. It's nonsensical, but again, $3 trillion is a very important figure in people's heads, because that is what's going to be important for, well, what is demand? Where is demand right now? How much demand is there going to be? And where is the assets being backed from? Where are, the asset growth is going to be important, because assets, the valuations have been dwindling. So as assets have dwindled, it means that they have to make sure that they have collateral. And that's where foreign reserves come in, as they've been trying to drum up support, as they've been trying to create and compensate for the zero COVID policy. They've had to liquidate foreign reserves. So there's a lot of concern around it. Now, PPI was expected to be down 1.5%. Instead, it was down 1.3%. So it's now deflationary, which is a good thing for the U.S. because we import that, which is a positive. CPI was expected to be up 2.4%, came in up 2.1%. That is good, but we want to look at what drove that, because food actually was on the high side, which is a problem when you look at the general Chinese consumer. Now, when you look at the financing data, aggregate financing was abysmal, was expected to be 1.6 trillion, came in at 907 billion. New yuan loans was expected to be up 800 billion, came up 615 billion. Loan demand isn't there. And that's, again, all of this is speaking to credit impulses, stimulus. It's not working. And that is a big problem, because everybody in the market keeps expecting this massive surge in liquidity, this massive surge in demand, and the supply is there. There is no shortage of debt in the Chinese market. There is a massive shortage of demand for debt in the Chinese market, because everybody's levered to the gills and nobody has the capacity to borrow more, which is why every time exports have slowed, trade has slowed, the government just pumps extra into the market, and it's just not there. Taking this to the next level, Chinese CPI, you can see came down. Chinese core CPI, though, flatlined. And that's important, because China reiterated their zero COVID policy, urges more targeted controls, vows to avoid one size fits all. So again, one of the biggest issues that has been happening since last year is the CCP getting angry at local governments, local provinces, for doing too much. But the problem is there's a bigger political loss, if you will, if you don't do enough and you allow a spread. So that's why all of these politicians are erring on the side of caution and are trying to do too much, but it's creating underlying problems. These problems coming into the consumer price rose 2.1%. Producer prices are now well and truly in deflationary areas. So consumer price growth is also slowing, but the high food prices continue to boost CPI. Food prices jumped 7% last month. The price of pork spiked 51.8% year on year, the fastest this year. So The food side is becoming an issue. Stripping away the food, non-food prices increased 1.1% in October, down from 1.5%. Core CPI, excluding food and fuel, was flat at 0.6. So you're still seeing pressure on the thing that people need the most, food, which is why we've talked so much about what is happening with crops, what is happening with purchasing, because they need to do something to offset the pain that is happening at the consumer, where they're seeing this firsthand. Previously, moribund domestic demand was partially masked by strong overseas purchases of Chinese goods. With export growth now slowing, weak domestic consumption will have a more noticeable feed-through to the headline economic numbers, which is what we've been highlighting. Now, when you look at Chinese PPI, US PPI, typically there is a connection, but it can break down. And as the US has nearshored, onshored, use your terminology, China is the number one country that US companies are moving away from. We still have reliance. I'm not saying we don't, but the impacts aren't going to be the same. And we're seeing inflation, actually, Taiwan, inflation accelerated more than expectations. South Korea, same thing. Other areas, India, same thing. Other areas that are pivotal to the US supply chain are seeing inflation go up. So while PPI is coming down in China, positive, there's that offset, which is why you have to weigh two different pieces. Now, when we look at some of the different commentary on Chinese zero COVID policy with this in mind. So as we've been saying, that zero COVID policy is set to stay in place for the foreseeable future. Rumors and optimism around a potential policy shift persisted. Former government ophthalmologist Zhang told an investment banking conference that Beijing would soon make substantial changes. Finally, Chinese officials weighed in on the matter themselves on Saturday, where they held a press conference where officials shot down the recent rumors. Who's the head of the Center for Disease and Control and Prevention? The NHC and the CDC will continue to guide all localities adhere to the general policy of dynamic clearing, zero COVID, and scientifically, accurately, and strictly implement various measures for epidemic prevention and control. Practice has proven that our strategy and measures are completely correct, the most economically and effective. Zero COVID is still the best approach to the pandemic, and we aren't backing away from it now. Local citizens and investors, though, are obviously tiring about it because the citizens are struggling to get food or struggling to maintain jobs. What is their savings? What are they spending? Do they have enough to survive? And investors are like, well, I built a facility here and you're locking me out. Why am I going to stay here? Or why am I going to invest further given a lot of these phase outs? As Trivium has argued repeatedly, any significant change to such a crucial and controversial policy will have to be done gradually and with months of targeted messaging from various party bodies. So this could be the start. We could start to see something, but it's going to be a very gradual shift and will likely come in 2023. Now, this is going to run counter to that because China reported the highest. China reported 8,824 new cases, the highest count since May 1st, when Shanghai was still buried deep in a lockdown. Total daily case count remains low by global standards, but again, it's in mega city Guangzhou, with a population approaching 19 million, with a GDP of 2.82 trillion renminbi, has reported 2,000 cases for 3 consecutive days. Chongqing, the giant southwest city with a similar-sized economy and an even bigger population, is dealing with its worst outbreak in over a year. Authorities in both these areas are trying hard not to resort to citywide lockdowns due to concerns about the economic toll and fear of what Beijing would say. But if it continues to spread, are they going to lock down harder? And that's going to be the big pivot to see where this looks. So just as we're going, the Politburo released a readout of its latest meeting, which was all about COVID policy. The top people, so in the standing Politburo, indicated that they are looking to implement 20 small tweaks to optimize the policy without naming specifics. They also indicated that on-the-ground officials should increasingly target COVID policies to meet local needs and realities throughout the country. but they were also crystal clear that stamping out the virus wherever it appears is the top priority, and underscored that necessary epidemic prevention measures cannot be relaxed. We expect Beijing to broadly stick to its guns for the foreseeable future, but we're looking for signs. Again, these are things that we're going to have to pay attention to. So now, central officials are once again looking to call out local governments for overly excessive COVID controls, which is why we're getting these back and forth and this concern with, well, are we doing too much? Are we not doing enough? They would rather do too much, stamp out COVID, which is the underlying goal, and then get criticized for doing too much, given the concern and again, trying to maintain a certain amount of semblance of CCP, positive views. Now, when we start looking at diplomacy and foreign policy, so as we talked about, the view of China on Taiwan was held consistent, but there is a view of a tiger form of the way that China is going to interact with international partners. So Foreign Minister Wang Yi published an editorial in the People's Daily on the future of Chinese diplomacy. And in it, he outlined the fundamental purpose of Chinese foreign policy, achieving national rejuvenation. China's development has entered a period when strategic opportunities, risks, and challenges coexist, and uncertain and unpredictable factors are increasing. The great rejuvenation must be accompanied by a great struggle. We should further study and practice Xi Jinping's diplomatic thought under the banner of Xi Jinping Thought on Socialism with Chinese Characteristics for a New Era. The centralized and unified leadership of the party is the greatest political advantage of China's diplomacy. There is no superior freedom and democracy, and there is no exclusive universal value. Imposing national values on others can only increase the source of turbulence and cause conflicts. China's diplomacy is about creating favorable external conditions for domestic developments. So again, it's still looking hostile, and there's no softening in this. And again, doubling down on the party. And this is what we've been trying to talk about. When you go into some sort of issue, and when under Deng, it was let some get rich. They are doubling down on control and party focus. Where in the past it was building businesses, getting out there, building a economic powerhouse. Now, as growth is dwindling and harder, they're focusing way more on control and party unification. None of that is good for global growth and expansion, and that's what I think some people are missing when they're looking at the different commentary coming out of China. When you look at the data in general, again, going back to exports, which are so important, when you look at outbound shipments recorded their first year-over-year fall since May 2020, and that print was significantly worse than the 4.5% year-over-year increase that analysts were expecting. A drop in overseas demand as Western households deal with a cost of living and sales of pandemic goods slow. Disruption to manufacturing production continuing to create an issue. So again, there's so many problems that continue to reverberate and we don't see it changing. But one of the biggest ones, China's offshore dollar bond issuance is falling, because there's no appetite for it given everything we just described. So the monthly change in foreign holdings of Chinese domestic bonds is getting absolutely obliterated because there's a lot of risk, so they'd rather go somewhere else. What is going to happen with Chinese COVID policy? What is going to happen with exports? What is going to happen with onshoring, nearshoring? What does common prosperity mean? What is Xi going to do to the economy as the focus remains and pivots more and more towards CCP control? This is a lot of concern as asset values continue to diminish. So if you remember back in 2009, 2010, it was all about getting into China, largest consumer in the world. They're going to be a massive powerhouse. That has never materialized, and now it's actually going extreme the opposite, even further to the extreme, where there's even less consumption than there was. And so the local market has never materialized, and that was what a lot of companies were investing in. And that's why we continue to see this outflow, which is going to put pressure on also China's ability to access the public markets. And we do think that that is going to continue to get worse, as we saw again with the data coming from the new loans. Chinese foreign exchange reserves, again, bumping along the bottom, not getting any better. And coming back to the existing homes prices, there's actually there's a number of cities, 70 cities existing home prices, and you can see that home prices are decreasing again at an accelerated rate. They've done nothing to fix it. And that's going to depress asset prices, depress valuations, and again, put more pressure on the underlying economy. India, on the other hand, when you look at business activity, rates of increase in sales and output quickened in October. Inflationary pressures also gathered pace. Firms are upbeat, but again, inflationary pressures continue to be a concern, which is going to be something to watch when we look at India and how some of these other economic areas progress. Japan's trade balance came in, bounced a bit higher, but you can see it still remains deeply negative. The survey was to be down 1.68 trillion. Instead, it came down 1.759 trillion. So again, still a big problem on the Japanese front. Japanese cash earnings came in better than expectations, with Japan real household spending coming expected to be up 2.6%, came in 2.3%. So things are still fairly stable internally, but as we talked about externally, you continue to see trade fall off, and as inflation picks up, we do expect to see more household spending diminish. So that's what we have for you on Asia. If you have any questions, please feel free to reach out. We'd love to hear from you. Love your feedback. And again, thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.